Hey, the Fed just cut the rate. That means mortgage rates are dropping. Not exactly. There's something you need to understand when the Fed says they're going to cut rates. It actually doesn't directly impact mortgage rates or mortgage-backed securities. What that is it's actually called a Fed funds rate. So let's say they're going to cut rates by a quarter point. What they're actually doing is they're actually cutting the rate by which the depositories loan money to each other. The banks are loaning money to each other on an overnight basis. You see, banks have to hold a certain amount of reserves. So they have to hold 10% of whatever the deposits that night. They have to hold that in reserves. They're loaning money to each other overnight lots of times, billions of dollars. So when the Fed cuts the rate, the Fed funds rate is actually being cut on money they're loaning each other. So why do we all think that it's tied to the mortgage rate? Well, just because we say, hey, the rate's dropping, it makes us think the rate's dropping. Now, if that doesn't affect the rate, then what does affect the rate? Very legitimate question. I'm going to sum it up in one word: everything, right? If we have a trade crisis going, if Greece borrows money from Germany, if the housing market's down, if construction's down, if the lumber supply or the, let's say, how many jobs are out there, all these factors affect consumer perception, consumer confidence, and affects ultimately mortgage-backed securities. So really everything, how's the stock market doing? Everything affects it. But when the Fed says they're going to cut rates, they're actually not cutting mortgage rates. So please take that information, help you understand exactly how the Fed funds and Fed rate cuts are actually impacting mortgages. If you'd like to learn more or just want to talk about it, give us a call here at 719 Lending.